Welcome, my name is Vishal Texanani. Today I'm interviewing Kate Howitt in our latest Meet the Manager episode. She is the Portfolio Manager at the Fidelity Australian Opportunities Fund, and she's going to share with me some insights on how she got into the investments business and some of the lessons she's learned in her career that she's going to share with you. Kate, it's great to talk to you. How are you?
Very well, thanks for having me.
That's great. Kate, whenever I meet a fund manager for the first time, I always like to know what drew you to becoming an investor and why did you join Fidelity?
I took a roundabout path to get here. I did a liberal arts undergraduate degree. I then did an MBA at the University of Chicago. I came out of that and joined the Boston Consulting Group, and then moved into corporate side of AMP, and then eventually moved into the investment side of AMP Capital. When I look back and say what was the common theme through all of that, it was really a fascination with what makes a great company.
Yeah.
Whether it was the work I was doing in industrial organisation during my degree work, or working with the clients of BCG to help them improve. So being an investor is just another way of exploring that. What makes a great company versus a not so great company, and what's the right price to pay for those? That's what I love, is I get to come to work and explore that question every day.
Okay, I love that fascination of yours. What makes a great company? Great segue into the next question. So, you know, as you look at the market, Australian equities, it's quite a dynamic asset class. You've got the ASX 200, you've got small ords. So there's a lot of choice for investors. How do you identify what makes a great company, and then how do you build a portfolio of great companies?
Yeah, I think that the two go hand in hand. The Australian market is actually, in the scheme of things, a very small, narrow market. There's not that many stocks to choose from. So what we've found is you're better off not to have too much of a style bias. If you just lock into, I'll only buy growth companies, or I'll only buy value companies, or equity income, you find that you're narrowed down to a very small number of companies. And you're also going to lock yourself into outperforming in some market conditions and underperforming in some market conditions. So for us, the narrowness of the Australian market makes us want to be all weather. And so it makes us want to explore all types of mispriced stocks. So what you'll see come through in the portfolio is there are some growth companies that we think are going to continue to grow and do well, even though the valuations are quite stretchy. Then we've got some companies that are unloved, that we think are quite cheap. They're value opportunities. So a real diversity, and then there are some small names in there, some companies that are not yet even generating a return, but we think they have enormous potential. So we want to pick the best out of each of those and have those come through in the portfolio, and that way it gives some resilience to the fund.
Okay, now I love what you mentioned there. So from an investor's perspective, it might pay dividends, if you will, to be style agnostic, not necessarily think about, oh, is this a value company or a growth company? Is it a great company?
Well, we still think it's important to know what sort of business it is, and we really want to make sure we understand the economics of the business. Are the returns going to be high or low? The ability to reinvest going to be large or small, because that will tell you what the economic value growth potential of the business will be, and therefore how should you think about valuation. Companies that are creating a lot of economic value in a short space of time are going to trade on richer premiums. Companies where the value is going to be pretty flat, they can still be worth owning if you can buy them for well below what they're worth. So we think it's really important to distinguish the sort of company you're talking about, and make sure that you're judging each one on its merits.
Okay, and how do you put them together in a portfolio? How do you think about, you know, the weightings of these companies from a risk management perspective?
Yeah, there's a lot of different factors that come together to make a portfolio well balanced. We're trying to have different types of opportunities, so a range of value, growth, small, dividend. We're trying to have representatives across the major sectors. We wouldn't go terribly over or underweight at the sector level, because there's generally something good on offer in each of those if you can judge them on their merits. So we know that our analysts are able to uncover mispricings at the individual stock level. So portfolio construction is all about letting that come through in the returns of the portfolio, rather than getting volatility from having other tilts in the portfolio. So portfolio construction is really just about stripping out everything that could be impacting the portfolio aside from individual stock names.
Okay. Okay. Now, I assume that this process wasn't the first process you thought of. It was refined, and it was a process of evolution and a journey over your investment career, which is what I'd like to focus on. What are some of the lessons you've been in the markets for more than 15 years? What are some of the most interesting, hardest lessons perhaps you've learned over that time that's led you to, have this psychology as it relates to investing?
Yeah, I think there's so much that you learn. For smaller companies, where you have stars in your eyes because you can see the potential of what they might become, it always takes longer than you think or the management thinks, and that always means there's going to be an extra capital raise or two in there. So, we do own some of those stocks, but it's where we've got conviction that the upside is enough to where the extreme dilution that you're going to have along the way. So that's one thing at the smaller end. Kind of in any company, you can have management lie. It's our process involves a lot of interaction with companies, and it's very disheartening to realise that a management team that you've been talking with over years has actually been lying to you. It does happen. I think that behaviourally, you've got to learn to be contrarian. It sounds trite, but it is true that some of the best buying is when you're almost feeling physically sick. When the market is hating a stock so much that is just going down, down, down every day, and you look at it and go, that's oversold, that's ridiculous. But to make yourself actually buy it, because you're thinking, what if I'm wrong? What if the market's right? I'll look like an idiot. So it's, we kind of say, like, no one's born feeling great jumping out of a plane. You've got to train yourself to do that. In the same way, to be a great investor, you have got to train yourself to be contrarian, to do the opposite of what most of the market is doing. Not always, sometimes the market is right, but where your analysis and your numbers prove up a great opportunity, you've got to be prepared to have that conviction and back yourself, even though a lot of people would say you're crazy.
Okay, that's fascinating. And tell us about the Fidelity Australian Opportunities Fund. At NabTrade, our investors have choice in terms of being able to construct a portfolio themselves, but they may also look at managed investment opportunities like your fund. This is a fund that you started at Fidelity, actually, wasn't it? If they were to look at a product like this, tell us about where it could fit in a portfolio. What should they know about it?
So it's really my expression of the best you can do in the Australian market. I have my superannuation is invested in this fund, and I opened my statement last night and was happy to see that it had gone well. So it's designed, as I said, to be resilient and all weather. I don't want to just be a growth fund that's going to shoot the lights out on the way up and then go really badly on the way down. I'm not a contrarian value fund where I'm out of favour for a long time and then hoping to really shine when value has a big resurgence. I'm trying to avoid most of those big biases and deliver outperformance every year at the stock level. Because of the portfolio construction approach, where I'm prepared to look at all different sorts of opportunities, I've got some of the largest stocks in the market and I've got some very small stocks in the market. And so it also has a place where you want exposure to the Australian market and you don't want to just have large or just have smalls. If you want, kind of all in one, I've got it for you. I've got the large, I've got the smalls. I've got some, a very strong dividend yield that comes through from the larger stocks that I own, but also some good growth potential coming through from some of the smaller stocks.
Okay, Kate, thank you so much for such a fascinating interview. I think I've learned a lot from this. If I can summarize some of the key lessons there, especially for smaller companies, it's about building a really small thesis about these companies and sticking to them over the long run, weathering those capital raisings like you mentioned, having a filter for management speak, and being contrarian when the market's going the other way. I really like that. Thank you so much for those insights.
Thank you.
No problem. I hope you enjoyed this video. Now, please remember, if you wish to transact in any of the stock ideas that we mentioned, or you're thinking about investing in the Fidelity Australian Opportunities Fund, it's really important that you do your research and consider seeking financial advice. My name is Vishal Texanani, and I'll see you next time.